Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 319 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including small caps and GE making new all-time highs, September seasonality, NASDAQ strength, a comparison to the late 90s, and qualified charitable distributions. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So we will jump right in. Good morning, Matt. It is September 23rd. Big week for me because I'm a huge golf fan. We have the Ryder Cup this week. So America takes on Europe at Bethpage Black in New York City. So that's going to consume most of my Friday through Sunday. I am visiting my brother this weekend, but definitely going to be watching that as much as I can.
That's going to be fun for you. I'm excited for you.
Yeah. So looking forward to that. UD basketball is getting closer and closer. We've been talking about games and tickets and that type of stuff.
Getting excited for that.
We're in full fall mode. Went to the pumpkin patch with the family this weekend. So
I hear pumpkin yields are down this year.
Really?
That's what I've heard.
Yeah. Kenzie mentioned that she didn't think there was as many there this year.
Her
but
observation would be spot on with the data.
Yeah. Well, that I was wrong because I was like, well, we're coming a little earlier in the year than we usually do, so maybe they don't have as many out. But yeah, that's interesting.
I heard that.
Yeah. The only thing we're missing for fall here in Ohio, at least, is the cooler temperatures. It's still been pretty hot here, at least for September so far.
Good observation. I will notice the leaves are starting to turn when you look in certain places a little bit. I'm excited for that mid-October, the colors. Oh.
Agreed.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Well, we are going to jump into returns of the major indices, that we track. This data is from YCharts as of the market close on September 22nd. S&P 500 is up 3.6% for the month and up 13.8% for the year. The Dow Jones Industrial Average up 1.8% for the month and up 9% for the year. The NASDAQ Composite Index up 6.2% for September and up 18% on the year. The Russell 2000 Small Cap Index up 3.9% on the month and 10.6% on the year. And the All-World Vanguard X United States Index Fund up 2.9% for the month and up 24.3% for the year. 3-month Treasury rate at 4%, the 2-year rate at 3.61%, and the 10-year Treasury rate at 4.15%. So getting right into it, Matt, the first thing I had in terms of tweets, articles, and research from this week was a post on X from Alfonso de Pablos, who's a CMT that's been on the show before. And he says, after 969 days, the Russell 2000 ETF finally closed at new all-time highs, ending its longest drought ever. So this is the Russell 2000's first all-time high since November of 2021, to be exact. And to piggyback off of this, I wanted to share some research from Federated Hermes that showed small caps historically have outperformed their larger cap peers in the market in general, just after the Fed starts cutting rates. So again, this data is from Morningstar, and what this graphic is going to show, and I'll verbalize it for those that are just listening, is the average total return of the Russell 2000 small cap index, the Russell 1000 large cap index, and then the S&P 500. And these are going to be for 12, 18, and 24 months after the Fed's first rate cut in a cycle, right?
Yep.
So 12 months after the first Fed rate cut, small caps up on average 19.5%. Russell 1000 index up just under 15%, and the S&P 500 up just over 14%. And then if you look, 2 years out or 24 months after the first rate cut on average, small caps up a little over 15%, Russell 1000 up a little under 14%, and S&P 500 up about 13.24%. So I think pretty consistent across different time frames that, again, small caps usually tend to do well when rates come down. The reasoning for that is, smaller companies that aren't your Apple, Amazon, Microsofts of the world do not have as favorable lending terms as those companies do due to their size, their strength, their financial stability. You can go down the line. And when shorter term rates come down, that means usually that these smaller companies can borrow at more favorable terms, which in theory should help their company's financial performance and in turn their stock performance. And I think one of the interesting things that we have going on right now is inflation is still running higher than the 2% target that the Fed had that apparently they're not paying attention to anymore. And usually when you have inflation that's higher than average, small caps tend to struggle, but I think they only tend to struggle if interest rates are going up to combat that. And that's not what we're seeing right now, right? We're in a cutting cycle. So a lot of interesting things going on with small caps and what affects small caps right now. But, as an investor, it's nice to see, this index make a new all-time high because it's been just kind of stuck in a sideways choppy range for the past 4 years, really.
Yeah, well said. I mean, smalls have been a tough trade. Everyone knows that, right? It's nice to see it finally break that cycle, make a new high. The reasoning that you laid out for our listeners and viewers as to why traditionally small caps do better in a lowering interest rate environment makes a lot of sense. I'll be curious to see how this trade continues to evolve, not only as the rest of the year goes on, but especially going into that midterm election year. It's definitely encouraging, though, because small caps have just been so out of favor.
Yeah.
So out of favor.
Yeah. It's been time.
Yeah.
Or it is time right now for them to show some strength.
Yes, it makes sense, and to see it actually happen is encouraging.
Yeah. Yeah. Agreed. So second thing I had was a post on X from Rob Anderson. This was back on September 15th. So Rob says, a reminder that most of September weakness has usually been backloaded. And he shares this graphic that shows the S&P 500 index seasonality by like each half of each month, right? So for the first half of September, I would say that stocks don't tend to be strong, but they're not extremely weak.
Well said.
But in the second half of September, you can see pretty clearly that the mean and the median, going all the way back from to 1950 through 2023, most of the weakness in September is back half loaded.
What a classic Ned Davis research piece, right?
Yeah, it is. So I just thought it was interesting because we haven't gotten that September weakness yet. There's still, 7 days left for that to happen in the month. But I think it'll say a lot if that weakness doesn't show up in a period during the year that tends to see stocks struggle. And especially over the past, I think 2 or 3 years in a row now, we've had a point in the fall and starting usually, or September is usually in the middle of it, where things tend to be pretty poor.
You've made my point I was about to make, because I got a couple pieces talking about seasonal weakness here.
Shocking.
But if everyone's looking at the same stuff right now, expecting seasonal weakness, and everyone's thinking, well, when that dip comes, I'm going to, take my turn at bat. What if you actually don't get some pitches and you're Barry Bonds in his prime?
Right. Yeah, that could be a problem for people.
And again, I'll say it again. If we do get any dip, it's going to feel a lot worse than it actually is.
Yeah.
It just will because of this low volatile environment we're in.
Yeah, but I mean, it could
3% will feel like 7.
Yeah, and it could be 5 to 10% because we really haven't had
and that'll feel like 15 to 20. It'll feel like
right, because we really haven't had any sort of prolonged weakness or substantial weakness, I guess I should say, since the lows in April. So
I'll get all fired up when I see all the headlines. Assuming that happens, oh my gosh,
Right.
it just get me fired up.
last thing I had was a post on X from Null Charts on September 16th. So he says, took 25 years, but GE is back. So GE Aerospace hit a new all-time high this month. It's the first one since September of 2000, Matt. Does that bring you back?
That does bring me back. My gosh, I remember trading GE at like $6 or $7 a share during the GFC.
Yeah, you can see pretty clearly on this chart that it was. This is an adjusted chart, but anyways, I really wanted to highlight this example, not really to talk about GE itself, but just to talk about opportunity cost in general in the market.
Keep going.
So, for those maybe who are unfamiliar with the term, opportunity cost in the market is the potential benefit an investor misses out on by having their money somewhere else, right? Or choosing one investment over another. And since money is usually limited for most people, every decision to buy or hold something is a decision to not buy and hold something else, whether that's another stock, if it's a bond, if it's a different asset class, right?
Yep. Every yes is a no to something else.
So my point is, even though GE is now at an all-time high, and there's been a huge run since about, the bottom of the market in 2022 from $40 a share to almost $300 a share, there was also a huge opportunity cost to hold GE for the past 25 years because the market did so well over the past 25 years. And there were hundreds, probably thousands of stocks that did a lot better than GE did. So I just wanted to throw that out there that, I think opportunity cost is something that a lot of people don't really talk about, but need to be aware of. And the classic example that I like to use is if someone buys a stock and it's down, 30%, they're like, well, I'm going to hold this stock until I break even and gets back to zero.
Keep
right?
going.
And it could be a situation like GE, maybe not as bad. Let's say it takes 3 years to get back to break even, but the S&P 500 or another stock or another index fund is up 50% in that 3-year period. Well, you're making a decision to, feel better about yourself when you break even rather than just selling your loser and reinvesting in something else that's going to go up more. And obviously you don't know that at the time, right? But that's just one of the risks of getting, I think, emotionally tied to a stock or having the mindset that you just need to get back to break even or just being down only 6 or 7% rather than taking a 30% loss and just taking your medicine.
Yeah, you said this well. I don't have anything to add. That's great.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
I'll turn it over to you.
All right, here's the things I picked this week. It's funny how we keep talking about where the market's at. So the first piece I have is from Neil Sethi, and this was posted on X on September 18th, Mark. And Neil was referencing a bespoke investment group raw research piece, and this is what Neil said. Over the last 4 months, the NASDAQ has closed at overbought levels on just under 93% of trading days. While readings this high aren't unprecedented, they are rare. In fact, there hasn't been a higher frequency of overbought daily closes for the NASDAQ in a 4-month window since August of 2020. And the reading has only been above 85% on 0.04% of all trading days in the NASDAQ's history. That's 4 basis points. Overbought markets can't stay overbought forever, so eventually we'll see the market pull back from these levels, but for now, it's been an unbelievable run. So I went ahead and pulled some data on my own, Mark, from stockcharts.com, and I went back to August 1st of 2020, the last time this occurrence had happened. And for the S&P 500 index, again, according to stockcharts.com, the following 6 months, the S&P from that point was up another 15.37%. And 1 year later, 12 months later, it was up 34.37. Does this guarantee a positive return over the next 6 or 12? No, it doesn't. But I want to throw it out there that, again, contrary to a lot of consumer psyche of wanting to buy things on sale, buying into strength, historically, taking a lot of things into context, tends to be a very bullish thing to do and optimistic. It tends to work out. I've referenced over the years statistics in regards to since the late 80s, you would tend to do better when you're buying the market at a high point, when it makes a new high. Again, contrary to consumer psyche, but it's just interesting because I feel like everybody's expecting the market to sell off, take a break. And we've been at this for how many months? I mean, seriously, we're at like 4, 5, 6 months of this. At some point, it'll happen. A broken clock is right twice a day. This is why you got to invest for your time horizon, not try to time this market. Your thoughts?
Yeah, this market's been overbought since May, right? So one could have looked at this and said, "Oh, it's May. Stocks are overbought. We should sell everything or get more conservative." And look what's happened since May, right? Things can stay overbought for a lot longer than people think. They can stay overbought for a year. Mm-hmm. And an example back in the day that just sticks out in my head, it's not a recommendation for or against it, but Tesla, for example. If you took a look at the RSI indicator, the 14-day RSI indicator, which stands for Relative Strength Index, it's just a kind of a technical indicator, a data point that people use to see, hey, how has this stock been doing, or is this something that's been going up for a long period of time? Has it been going down for a long period of time? And Tesla stayed well overbought according to the RSI indicator for, it was like several months, I think, right? And it's just one of those things that, like you said, it's not a timing mechanism, but yeah, eventually they're not going to be, not going to be overbought forever.
Yeah, and I think you've always kind of mentioned this on the podcast over the years that, rotation in the market, sector rotation, is the lifeblood of an uptrend or a bull market. Mm-hmm. Just take 30, 60 seconds and explain to our listeners and viewers, what is sector rotation and why does it tend to be healthy over the long term?
Yeah, so, usually when we're in good times, when the market's rocking and rolling, you have the aggressive areas of the market outperforming. Your technology is the first thing that comes to mind. Communication services, financials. But when that party stops for technology, usually there's another sector or a couple of sectors out there that take the baton over for a little bit, right? So some sectors that have been beaten down start to lead the market, and while that might not be great for the S&P 500 in general because it's so tech heavy, the market can still keep going as long as the other 10 sectors are pulling their weight, right?
Correct.
And I think a good example of this, you mentioned financials. Financials have been great so far this year, and just over the past 3 to 4 months, financials have performed very well relative to the broader market. So when you say sector rotation, like the early 2000s, technology can't continue to go up and up and up and up and up without a breather. Mm-hmm. That doesn't necessarily mean the market has to correct 25% when tech sells off, because there are other sectors that I think people think about that can step in and provide that broader leadership.
Well said. Again, my next piece is about seasonality. Here we go again. So this is from Jay Capel, and this is on September 18th. He's a senior market analyst at Sentiment Trader. He had a post that was about just a seasonality chart of the S&P, and it shows the number of trading days throughout the year. And what he is highlighting here is we're entering that seasonally weak period for the second half of September and the first half of October. And what the chart illustrates is after you get past roughly the middle of October, historically on a seasonality basis, Mark, the market tends to rally into the end of the year. So again, I'm just pointing out that that is where we are at in the seasonal chart, but obviously you and I are not the only ones looking at this. To add to that, Subu Trade put some data behind this. The post here, I'll get the date right, September 18th. The post says pullback soon, question mark. The S&P 500's RSI has stayed above 45 for 102 straight days, one of the longest streaks in history. In the past 60 years, the S&P was lower every time 2 weeks later. The data set, roughly about 10 or so data sets in here. And 2 weeks later, the market was down on average about 2.17%. Again, leading for me to say, wouldn't surprise me to say, see the market breathe a little bit here when I look at the raw stats.
Yeah, so the 2 week mark from September 18th would be October 2nd. It looks like it's Thursday.
Thank you, sir. Appreciate that.
Come back and check on that.
So let's take now a bigger picture view, okay? Because of the rally we've had off of the lows in April, and especially with some of the concentration of performance being in technology, we're getting the rinse and repeat cycle, Mark, of where we are at compared to the internet boom of the 90s and early 2000s. Are you seeing some of those comparisons once in a while lately?
Yeah. Oh, yeah.
Okay. So the first piece I have is a post by Ed Bradford, a trader I follow on X. Ed posted this on September 18th. And what it shows is the spread of the percentage of stocks in the NASDAQ 100 that are above the 200-day moving average, okay? And Ed posted, if you're playing for a stock market melt-up bubble, it is handy to have a way of judging scale. Tech bubble peaked at 57% for the NASDAQ 100. Again, 57% of stocks above their 200-day moving average. Currently, 14%. So I saw that post, and then it got me thinking. Then I see a post by Bespoke on September 20th. Bespoke did an overlay of Netscape. I'm bringing back the late 90s hits, baby.
Yeah.
So Netscape from December 19th of 1994, when it really started to get going, and it's going to show Netscape through roughly 1997, about 5 years, okay? And then next, it's showing an overlay of ChatGPT. So it's kind of showing the overlay of ChatGPT versus Netscape through the first roughly, again, from 94 through 97, okay? And at the top, it says NASDAQ composite percentage change in the 5 years after Netscape release versus ChatGPT release. And what do you garner from this chart when you see this overlay of the internet boom of the late 90s, Netscape, that internet browser, versus ChatGPT from this chart?
Well, Netscape, in late 1999, it essentially went 90 degrees vertical.
At the end of the period, yes. We're talking parabolic.
Yeah. It went from, what is it? Just over, it was 250% change to 450% change
in like
a couple
half a year.
Yeah, so we haven't seen that type of behavior yet, but yeah, I think we've brought this chart up before on the podcast, and it is a little interesting to see how closely these two huge tech booms have mirrored each other.
And we
I think that this is a great piece to show, or a great piece behind the theory that we're not near the top yet, is that, again, it's one of those situations, in my opinion, that this can last a lot longer than people think.
I agree. And from point A to point B, there's going to be sell-offs along the way. Just like the sell-offs you've seen from February to April this previous year, we've had them along the way the last 5 years. And when you look at this chart, I mean, the market had a nasty sell-off in 98 due to the Asian currency crisis, right? I mean, we had a very quick sell-off over 20% and a very quick V-shaped recovery. So it doesn't mean that in these up cycles, you're not going to have corrections along the way. But one could make an argument for those that are trying to provide the analogy of the late 90s, early 2000s versus where we're at today, and we're at that peak. The balance sheets are different, and a lot of the data is indicating it's not exactly at that peak top yet. And when I kind of look at the AI spending cycle, there's a lot of feeling that based upon these expenditure budgets of the big four, like an Amazon, an Alphabet, a Meta, go down the list, they're still planning on spending and accelerating the spending the next 3 years. And that could change. But when you look at a lot of this data, it tells me I just don't think that trade, when you have a longer term time horizon, I feel like it doesn't feel like it's dead yet to me.
Yeah. I just saw that NVIDIA made a huge investment into OpenAI.
I saw that
this week. It was
Was that
$100 billion or
100
something
billion.
like that? Yeah, that's crazy. We're talking about investments of hundreds of billions of dollars, which quite crazy. So, moving on to the financial planning topic of the week, QCDs, or qualified charitable distributions, are the topic for us this week. So we are getting to that point in the year where eligible investors may want to consider utilizing QCDs to help minimize their tax bill for 2025. So a quick reminder, qualified charitable distributions is a tax-efficient way for people over the age of 70 and a half to give money directly from their traditional IRA to qualified charity. So that money goes straight from the IRA to the charity. The amount given counts towards your required minimum distribution if you're subject to one, and the donated amount is not taxed as income, which obviously can lower your overall tax bill even if you don't itemize deductions. Mm-hmm. So that QCD limit, the amount that people can give and max out that QCD for 2025, is $108,000. So 2 points here that I wanted to bring up, Matt. Yep. The OBBA, the One Big Beautiful Bill Act that was passed earlier this year, QCDs reduce the RMD eligible taxpayers' modified adjusted gross income compared to taking the full RMD without a QCD. So this could serve as a valuable tool to keep an investor's income under key phase-out thresholds for certain deductions. And the big one that I wanted to highlight, because this has been a topic of discussion in our office over the past couple of years, is in the past, custodians where client money is held. So examples of that are Schwab, Fidelity, Altruist, go down the list. In the past, custodians have not been required to identify whether a distribution from an IRA is QCD or if it's just a normal distribution that people are taking income from the account.
Correct.
And that's been frustrating for a lot of advisors like us and their clients from a planning standpoint. So the person making the QCD was responsible for notifying their accountant or responsible for notating it in their self-service tax portal that a portion of the amount of money that they took out of their IRA was used for a QCD.
Correct, sir.
But in 2025, this is the first year where the 1099-R tax form will have a code for QCDs to make it easier to delineate which distributions are taxable and which aren't.
What a novel idea.
Yeah, they should have done this 10 years ago.
Oh, my goodness gracious.
Yeah, because that was, it was always a question from clients. They were like, so, they get their 1099-R and they were like, this shows I took $100,000, but I only took $70,000 because I made a $30,000 QCD, and it was always that having to go down the road of explaining that the tax documents and the custodians don't delineate what's a QCD and what's not.
Yep.
But it should be easier this year, which I think is cheered by advisors and for clients.
I think that's great.
Yeah. So
It's going to make life easier, especially March, April tax time, clients calling in to their advisors and custodians. Hey, how much? I don't remember how much I gave to charity. How much is it? And it's just great having that in the form.
yeah,
Oh my
it should
goodness.
be a lot easier. So anything else before we leave it there?
No.
Okay.
No, again, we're kind of in that no man's land. We kind of talked about it. Some people think the market's dull right now. I absolutely love this because I know it's not going to last.
Right. Yeah. Periods like this are happy times here at Jessup Wealth Management. So, well, thanks everyone for listening to episode 319 of the Independent Advisors Podcast. We will be back with you next week for episode 320.
Thanks, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.